Cathie, good to see you, and thanks for coming on with us. Let's start broad. October is certainly off to a strong start, and it feels like the bulls are hoping that the Fed may not be as aggressive going forward, something that you've repeatedly called for. That sentiment did underpin the summer bear market rally, but ultimately led to new lows. What is your read of the moment of market sentiment?
Well, interestingly, our strategy did not hit new lows, our flagship strategy. That is quite normal toward the end of a bear market. We did see the broader averages hit new lows last year, and yet we maintained our low, which was actually back in mid-May. Innovation tends to be the new leadership as we move out of a bear market. And if we're right and the Fed's close to pivoting, whether in rhetoric or otherwise, and they have a lot of reasons to pivot, even more now after the LDI crisis in Europe, we may have something similar going on here in the United States. And we also have big deflation in the pipeline. Just one commodity price after another has been capitulating. So that's at the beginning of the pipeline. And then at the end of the pipeline, we have inventories overwhelming companies. And we have a consumer that is not playing ball as much as he or she was before. So we think this holiday season is going to be quite tough and is going to include a lot of discounting. We believe that the Fed is going to be quite surprised at the deflationary pressures that start hitting the headline inflation numbers during the next 3 to 6 months.
So, Cathie, are you anticipating an actual pivot or a pause? Does that happen sometime next year after what you say may be a rough holiday season? I mean, even though the Fed has said that they remain determined, they need to see more of this. Do you think that that's possible?
I think that the Fed is looking not just at the economy now, which is pretty weak, and if you combine that with the notion that our major trading partners are in recession, I'm sure they're on guard. But there are also signs that there's distress out there in the financial services sector. We've been watching the credit default swaps of money center banks doubling and tripling. And you know, in Europe, they're out to all-time highs. And so there are stresses and strains in the financial system that I believe have begun to show themselves, first with the LDI crisis in the UK. And the reason this is happening is we are experiencing a major financial shock. If you look at, Volcker is, Chairman Powell is invoking Volcker's name and his Keeping at It book title because I think Chairman Powell thinks we have an inflation like we had in the 70s, 80s. Chairman Volcker increased interest rates from 10 to 20% in an inflationary environment. That's twofold. Chairman Powell and team have increased interest rates 13-fold from their lows. And we believe when history books are written that economists will be looking back at this saying, wow, what a shock to the system. And so I believe credit default swaps are going up for a reason, and we will find out what those reasons are over time.